Do you want to supercharge your money and get ultra high dividends every single month that can pay for the vacation you have wanted to go on for years? I will tell you, but first suplex the like button. Alright folks, let's dive into the world of finance. Where the water is warm, the jargon is thick, and the potential for millions is as vast as the ocean itself. Today, we're talking about a fascinating creature in the financial ecosystem, the Covered Call ETF. But before we dive into that, let's start with the basics. The stock market, in its simplest form, is a place where people buy and sell shares of companies. Think of it like a giant, global garage sale, but instead of old clothes and vintage records, people are trading pieces of businesses. Now, within this bustling marketplace, there are different types of products you can buy. One of these is an ETF, or exchange-traded fund. An ETF is like a basket of different stocks, all bundled together. It's like buying a fruit salad instead of individual fruits. One type of ETF is a dividend ETF. These are funds that focus on stocks that pay dividends, which are like little thank you notes from companies, in the form of cash, for investing in them. ETFs have been around since the early 90s, and they've been a game changer for investors. This was a revolutionary moment in the world of investing, as they offer a way to diversify your portfolio without having to buy each individual stock and get dividends too. Fast forward to today, and there are thousands of ETFs available, covering everything from broad market indices to specific sectors, commodities, and even strategies like covered call writing. Now, let's get to the star of the show, the Covered Call ETF. Wait till the end of the section to hear some great news. This is an ETF that uses a strategy called covered call writing. It's like selling someone an IOU for a stock you own. You get paid a premium for this IOU, and if the stock doesn't reach a certain price, you keep the premium and the stock. It's like selling someone the option to buy your old bike. And if they don't, you keep the bike and the money they paid for the option. Some of the big players in the Covered Call ETF game are the Global X Nasdaq 100 Covered Call ETF, QYLD, with a current dividend yield of about 11.01%. And the Global X S&P 500 Covered Call ETF, XYLD, with a current dividend yield of about 8.01%. These ETFs are like the LeBron James and Steph Curry of the Covered Call ETF world. To contrast with a typical blue chip stock, Coca-Cola's annual dividend yield is around 3.12%. Covered Call ETFs can be a great way to generate income and reduce volatility in your portfolio. But, like any investment, they come with risks. The market could go down, the option could end up defaulting. It's like lending your bike to a friend. They might return it in perfect condition, they might crash it, or they might move to another city and take your bike with them. The great news with these ETFs is it's the fund manager's job is to deal with the complexity of options and the covered call strategies for you, so don't have to worry about buying and selling the cover calls yourself. Understanding covered call ETFs. So getting into this strategy, when an ETF uses covered call writing, it's essentially selling someone else the right to buy certain stocks in the ETF at a specific price within a certain time frame. The ETF gets paid a premium for selling this right, which can provide a nice stream of income. Covered call ETFs function by investing in a selection of stocks and subsequently selling call options on a fraction of those stocks. A call option grants the purchaser the right, without any obligation, to acquire the underlying stock at a predetermined price, referred to as the strike price, on or before a specified date, referred to as the expiration date. In return for selling the call option, the ETF earns a premium. Should the underlying stock fail to reach the strike price before the expiration date, the call option becomes worthless, and the ETF retains the premium as income. Conversely, if the underlying stock attains the strike price, the ETF must sell the stock to the option buyer at the strike price but still retains the premium as income. The covered call writing strategy can potentially mitigate the ETF portfolio's volatility by generating income and offering a prospective hedge against market downturns. However, it's crucial to recognize that this strategy imposes a cap on the potential upside of the underlying stocks. In the event of a substantial increase in the underlying stock's price, the ETF might be obligated to sell the stock at the strike price, foregoing any additional gains. So that's the nuts and bolts of how cover call ETFs work, but the great thing is that Fund managers do all the buying and selling of the options, so you can just buy or sell the ETF as you wish. Taxation of covered call ETFs. None of us like taxes, but we all have to pay it, and it's no difference with covered call ETFs. Some dividends of stocks like Apple and Microsoft have dividends that are called preferred dividends. These dividends have lower or even 0% taxes, depending on your tax bracket. But with covered call ETFs it's a little bit different. Covered call ETFs undergo distinctive tax treatment due to their income generation method. As previously discussed, these ETFs generate income by selling call options on the underlying stocks within the portfolio, commonly referred to as option premiums, and this income is subject to specialized tax considerations. The option premiums received by the covered call ETF are classified as short-term capital gains, so it is taxed as ordinary income. Consequently, the income generated by the ETF is subject to the investor's marginal tax rate. Short-term capital gains typically face higher tax rates compared to long-term capital gains, which are generally taxed at a lower rate. So the tax rate you pay for your job income is what you will pay for holding the ETF. You can think about it like this: it's like if you sold that old car of yours. You'd have to pay taxes on the money you made. So, you can think of covered call ETFs more as a side hustle. That you don't have to do any work besides purchasing the ETFs and you get paid every month. Holding covered call ETFs in taxable accounts are obligated to annually report the ETF's generated income on their tax returns. This income is detailed on Schedule D of Form 1040, adhering to the same reporting requirements as other capital gains and losses. It's noteworthy that covered call ETFs may also generate long-term capital gains or losses upon the sale of underlying stocks. These gains or losses are likewise reported on Schedule D of Form 1040 and are subject to the identical reporting requirements as other capital gains and losses. Because of taxes, many investors may not reinvest the dividends directly into the ETF automatically every month, to take some of the money to pay for taxes and use the rest to buy more cover called ETFs. Okay, so you understand covered call ETFs better. But you've got to find out what are the pros and cons of these types of ETFs. Advantages of covered call ETFs. Income generation. Designed to yield income, covered call ETFs achieve this by selling call options on the underlying stocks within the portfolio. This consistent income stream makes them an appealing choice for investors seeking to supplement retirement income or generate cash flow from their investments. Volatility reduction. By engaging in the sale of call options, the ETF offers a potential safeguard against market downturns, potentially surpassing overall market performance. This contributes to minimizing portfolio volatility and smoothing returns over time. Tax efficiency. Given that covered call ETFs generate income through call option sales rather than dividends, they may boast greater tax efficiency compared to other income-generating investment types. Drawbacks of covered call ETFs. Counterparty risk. Selling a call option involves entering a contract with the option buyer. If the buyer fails to fulfill their contractual obligations, such as paying for the underlying stock, the investor may incur a loss. Market risk. Similar to all stock investments, covered call ETFs are susceptible to market risk. A decline in the overall market can lead to a decrease in the ETF's value, notwithstanding income generated from call options. Option risk. The sale of call options carries its own risks. If the underlying stock's price experiences a significant increase, the ETF may be compelled to sell the stock at the strike price, potentially resulting in a loss, which you may see in a reduction of monthly dividends and the overall ETF fund price going down. Now, we get to the exciting part. Let's take a look at 5 different covered call ETFs and their monthly dividend. Because we all like to get paid frequently, right? Global X Nasdaq 100 Covered Call ETF, QYLD. Launched in 2013, this ETF targets tech-savvy investors, as it focuses on the tech-heavy Nasdaq 100 index. Current yield is about 11.23% and the monthly dividend is about 16 cents. Global X S&P 500 Covered Call ETF, XYLD. A sibling to QYLD, this ETF was launched in 2014 and focuses on the broader S&P 500 index. Current yield is about 8.17% and the monthly dividend is about 30 cents. Global X Russell 200 Covered Call ETF, RYLD. This ETF, launched in 2019, focuses on small cap stocks, offering another option for investors looking to use the covered call strategy on this lesser-known index. Current yield is about 11.94% and the monthly dividend is about 17 cents. JP Morgan Equity Premium Income ETF, JEPI. Launched in 2020, this ETF applies the covered call strategy to larger cap stocks including Microsoft, Adobe, Amazon and MasterCard. Current yield is about 8.52% and the monthly dividend is about 39 cents. Nationwide Nasdaq 100 Risk Managed Income ETF, NUSI. This is one launched in 2019. It applies the covered call strategy to Nasdaq stocks including Nvidia, Apple, Google and Pepsi. Current yield is about 7.68% and the monthly dividend is about 14 cents. Each of these ETFs has its own unique history and focus, but they all share a common strategy, using covered call writing to generate income and potentially reduce risk. But remember, while the covered call strategy can provide income and act as a hedge against volatility, it also caps the potential upside of your investment. If the individual stocks in the ETF rise significantly, you might miss out on some of those gains because the fund sold the right to buy your stocks at a lower price since you are a holder of the ETF, not the individual stock. But if an individual stock tanks, you are protected from the downside as well. Depending on your investment strategy, this can be perfect for a person that wants to have a side hustle but not the constant work every day to earn some money on the side. So you know that covered call ETFs are for you, and want to check out how much money you can potentially get every month in dividends. Check out this video to find out.